Good day, everyone, and welcome to our webinar for April 2023. We will begin, as usual, in America, where the peak of the Fed balance sheet size was $9 trillion, following, obviously, their quantitative easing as a result of COVID-19 in 2020 and beyond. They have been reducing this by $95 billion a month since late last year. Of course, now we've got the collapse of Silicon Valley Bank, SVB, and when a bank collapses like that, it automatically reduces the size of the money supply straight away, because banks, of course, don't keep the money that you leave on deposit with them. They keep 10% of it, and they lend 90% out to someone else at interest. That's how they make their money. When a bank collapses, it sucks money out of the economy like a vacuum cleaner. So obviously, the Federal Reserve Bank has a problem now. They want to prevent a run on US banks, of course, but they still have the inflation difficulty. They still have to try and contend with inflation. The Fed has said that it will stand good for all the deposits that were made at SVB Bank. Of course, this is impossible. They can't guarantee all deposits for all banks in America. But it is comforting to the depositors. The Fed may have to slow down its quantitative tightening program or even stop it completely. And of course, this guarantee that they've given involves a certain amount of moral hazard. Because if the Fed is going to guarantee deposits, why do bank managers have to be careful who they lend money to? They can lend money to anyone. They don't have to check their credit rating or anything. They can just lend them the money because the Fed is going to guarantee it. If the depositor can't repay, then they've got a Fed guarantee. So this is a concern, this moral hazard problem. And it may lead to banks offering credit to people and businesses that are not creditworthy, creating a new problem down the line. In reality, the Fed should not prop up failing banks. If a bank is failing, it should be allowed to fail, and if their depositors lose money, well, that is part of the capitalist system. We have to pay attention to the financial strength of the organizations where we deposit our money. So that is a concern. Jerome Powell made some remarks on the 7th of March this year, and he re-established the Fed's hawkishness. As a result, the S&P 500 fell 1.5% on that day. But the effect was temporary. The Fed emphasized that it had the goal of bringing inflation down to 2%, and it suggested that rates would have to go higher and stay high for longer. At the time, after these remarks, the market was expecting that rates would rise by 50 basis points. Then on the 22nd of March, the Monetary Policy Committee put rates up by only 25 basis points. So rates are now between 4.75% and 5%. And the MPC suggested that only one more rate increase of 25 basis points would probably be necessary. But they did say that rates would remain high for an indeterminate period, so they didn't commit themselves there. We think it will now be a long time before inflation comes down. The sharp rise in rates has caused bond prices to fall quickly. You need to understand, of course, that bonds move inversely with interest rates. When interest rates go up, bond prices fall. If you can imagine a bond, a R1,000,000 bond or $1 million bond with a 10% coupon, if interest rates go up to 12%, then obviously you can now buy the same R1,000,000 bond, but with a 12% return. So what happens to the old bonds, which have got a 10% return, is that the value of the bond drops below R1,000,000 until the effective yield on the bond is 12%, like the new bonds coming out with the new interest rates. So that is why bonds fall when interest rates are going up. The problem is that a lot of banks in America have invested heavily in the bond market, like SVB did. And that means that they are exposed to rising interest rates and falling bond prices. At the same time, people are switching their deposits out of the smaller banks into the larger banks, obviously, because the larger banks have got a bigger capital base and are generally more secure. In fact, in the week to the 22nd of March, depositors withdrew about $128 billion from banks in total. In fact, total deposits have fallen 4.4% to $17.3 trillion at banks. Americans are taking their money out of banks because they're only getting maybe a 0.5% return there, and they can get a higher return by investing in treasury bills or money market instruments, which are offering over 4%. And of course, you mustn't forget that in today's world, you can switch your money from one thing to another with a few keystrokes on your phone. As Warren Buffett has said, only when the tide goes out can you see who is swimming naked. Of course, what he means by that is that it's only when things get difficult, when interest rates are rising, that you can see which companies are over-indebted, which companies, which banks are overextended. In 2008, the banks were heavily exposed to the property market. Today, many are heavily exposed to the bond market. As interest rates rise, the value of their bonds fall. This creates a potential dilemma for the Federal Reserve Bank. They have to choose between controlling inflation and supporting the banks. So it's a problem for them. Looking at other things in the American economy, core private consumption expenditure, which excludes food and energy, is a very important indicator in America. The Fed watches this very closely as an indication of inflation. So core PCE, or private consumption expenditure, excludes food and energy prices. And it has been more or less stable over the last 3 months at around 4.6%. It doesn't seem to be responding to the higher interest rates. And that gives us a bit of a clue, doesn't it? It tells us that the reason inflation has come down over the last 6 months is because the oil price has been coming down. I'll show you a chart of the oil price just now to show you why I think that. The underlying inflation rate, the core inflation, which excludes the energy prices and oil, has not really been coming down. But the bulls have been looking at PCE and saying, well, at least it's not going up, and they've taken that as a positive. They've added that to the fact that consumer spending fell by 0.1% in February, which was much better than January's 1.5% growth. And they've taken those two positives and they've said, because of these things, the Fed will most probably switch their policy. They will pivot by the end of 2023. The idea of a pivot before the end of this year has been gaining traction. And you can see in the S&P 500 that as it gains traction, the S&P has been going up very strongly. We believe that that optimism is unwarranted. Inflation is still at 6%, and it has a long way to go before it reaches the Fed's goal of 2%. As a private investor, you must formulate a view on interest rates in America. Are they going up or down for the rest of 2023 and into 2024? That will be the main factor in determining which way markets go. Don't forget that US unemployment is still at 3.6%, and the economy has generated 800,000 jobs in January and February this year so far. That is not really an economy which is cooling. There's no sign of cooling down as far as we can see. Rather, it is booming. We believe that the Fed will have to tighten further, and maybe quite dramatically, in order to get down to that 2% inflation goal. We think rates may have to remain high for quite a long time, and well into next year, certainly. We do not see the Fed pivoting in the short term. And as you can see from the chart on your screen, the cycle low point is over here on the 12th of October when the S&P 500 made a low at 3577. It's been going more or less up since then. So this is the third rally in the S&P 500. What you will notice, though, is that the long-term 300-day simple moving average is still falling, despite all these ups and downs. We did get a golden cross buy signal over here, as far back as the end of January, but I believe that that golden cross signal was a false signal. So my expectation is that the S&P 500 will fail to break above this long established and well established resistance at 4170. You see this straight line going across your screen here. It will fail to get through that, and then it will fall back. It will break this low here, and it will go on to break this low that it made in October last year. Don't forget also that the next year, 2024, is an election year in America, and election years usually have an impact on the S&P 500. The incumbent Democrats will want the economy to continue growing and booming because that will be the best for them. Together with the fragile banking system, this could cause the Fed to pivot too early. But inflation will have to be dealt with sooner or later. So a pause in tightening and quantitative tightening now may create a worse problem down the line. Okay, so that's what I think about what's going on in America. Let's turn our attention to Europe and just have a quick look at Ukraine. Of course, the winter offensive that Russia was planning in Ukraine has proved to be a bit of a damp squib. They gained almost no ground and made substantial losses. They incurred substantial losses both of men and material. Now Ukraine, of course, is planning a new counter-offensive using their new Western tanks that they have been receiving, the Abrahams, the Leopards, and the Challengers. There's no indication of where that counter-offensive will come from. We think it might go down towards Melitopol in an effort to cut off Crimea, to cut off the supply lines to Crimea. But it could be in Bakhmut or somewhere else. Nobody knows, really. The Wagner Group leader, Prigozhin, says that they have a shortage of ammunition and men in Bakhmut. So that is a problem for the Russians as well. In our opinion, Ukraine will gain significant strategic advantage now and ground somewhere in the eastern side of Ukraine. We still believe that Putin cannot survive a further major loss, especially if that loss is Crimea. If that happens, we think that Putin's political career will be at an end, whatever that means. In the meantime, Russia has been selling oil to India and China in rubles. This circumvents the EU sanctions and, of course, the oil price cap. It also erodes the US dollar's dominance of the oil markets. India has imported several $100 million worth of Russian oil, and obviously that is helping to finance the war in Ukraine. The suggestion has been put around that the petrodollar will by now be replaced by some other currency, and I see that the BRICS nations are planning to formulate a new currency. In my view, that is nonsense. The petrodollar will remain. The dollar will remain the international currency of preference. Just under 90% of world trade is done in US dollars, and about 62% of all central bank reserves are held in US dollars. I think it's extremely unlikely that any currency that the BRICS nations or anyone else produces will replace the US dollar as the international currency that most people want. Okay, let's have a look at the situation inside South Africa now. The political situation, just on an aside there, South Africa, of course, has invited Putin to the next meeting of BRICS in South Africa. The International Criminal Court has declared him to be a criminal, so he should really be arrested as soon as he sets foot here in South Africa. South Africa is a signatory of the Rome Statute, which established the International Criminal Court. Russia is not a member of the ICC, and Ukraine, of course, recently joined. South Africa, under Mandela at the beginning, in 1994 and beyond, became a moral leader throughout the world. And that leadership, that moral leadership, has been steadily squandered by the ANC over the last 25 years. The tacit support of Russia will have deep and long-lasting consequences for South Africa. The CEO of FNB, Alan Pullinger, says South Africa's position on Russia is despicable and not in the interests of South Africa. And he says it will result in trade restrictions sooner or later. At the same time, there is evidence that the ANC might have received donations from Russia at various points. So maybe that is what is driving them. Okay, Ramaphosa's reshuffle of the cabinet was a bit of an anticlimax as far as we were concerned. Nothing of importance was really done. Mantashe remains as the Minister of Minerals and Energy. We think that that was an opportunity lost and possibly an indication of Ramaphosa's weaknesses still within the ANC. The appointment of a Minister of Electricity was an attempt to circumvent Mantashe's obstructions in the energy industry. But as far as we are concerned, the reshuffle was really a case of rearranging the deck chairs on the Titanic. And possibly a move by Ramaphosa to try and retain his strength within the ANC. At the same time, the ANC, the government, has made a 7.5% settlement with the unions, the civil service unions, and that looks to us to be distinctly populist. It's an effort to gain support for the 2024 elections. It will cost taxpayers 51 billion rand over the next 2 years, and it's obviously far more than the 1.6% which was included in the February budget. The Treasury says that the extra money will have to come from departmental cuts. So in order to pay the civil servants more, we have to have cuts in the other departments from their projects and possibly retrenchments even. Some polls are now showing that the ANC has less than 40% of voter support, and they are quite rightly worried about that. The national shutdown, which the EFF called for the 20th of March, was, in our opinion, a complete failure. It shows that the EFF has lost a lot of its support. Some polls are suggesting they may have less than 10% of support nationally. And the national shutdown that day was very poorly supported and was quite humiliating for the EFF. But they could still team up with the ANC after next year's election. We have to see what happens there. We think it's more likely that Ramaphosa will want to team up with the DA, but we'll see what happens. Whatever the situation it is, you can rely on the fact that we will not be dominated by a single party anymore. There will be no party in South Africa with more than 50% of parliament. Okay, of course, the big story is Eskom and what's going on there. There was an independent report into the corruption at Eskom, which substantially validated what De Ruyter has said publicly in various interviews and so forth, despite the comments of the new Minister of Electricity. The ANC is obviously very embarrassed by that report, and they are in a damage control mode. The sabotage at the Tutuka power station was done apparently to discredit De Ruyter and Ramaphosa, and possibly in order to win contracts to do the repairs. It's scary to us that both the Reserve Bank and the JSE are now making plans for a complete grid collapse. It shows how rapidly Eskom is failing. Still on the subject of electricity, Sibanye has donated 30,000 hectares of land to the Gauteng province. The objective is to build an 800 megawatt solar farm. They're following in the footsteps of Cape Town, trying to get away from Eskom. Cape Town now avoids 2 stages of load shedding because of its solar and wind power. And of course, Eskom's income is falling. People are moving away from Eskom, making other power arrangements. Companies and consumers are leaving Eskom in droves. The city of Johannesburg has become worried about the fact that their revenue from electricity is falling rapidly. 44% of the Joburg city's revenue comes from selling electricity. The new solar power tax incentives have made the situation worse. And you shouldn't forget that collectively the municipalities owe Eskom about 150 billion rand, which I think they will never collect. That's my view. Okay, let's look at the economy. Obviously, we had a 0.5% hike in interest rates during this month. The Monetary Policy Committee is clearly staying ahead of other central banks, like the US. We need to keep our bonds attractive to overseas investors to ensure a flow of funds into the country. The Monetary Policy Committee says that the hike was due to the potential impact of load shedding on prices. And I think that there's quite a lot of validity to that. Inflation is predicted to be 6% in 2023, sharply higher than the previous prediction of 5.4%, mostly because of the perceived impact of load shedding and the fact that businesses will have to pass on those costs to consumers sooner or later. The hike in interest rates caused the rand to strengthen to just below 18 rand to the US dollar. And we'll talk more about that in a minute. The consumer price index rose by 7% in the year to February, slightly up. Companies are passing on the cost of power outages to consumers. Core inflation, which of course excludes food and energy, was 5.2%, up from January's 4.9%. Gross domestic product shrank by 1.3% in the fourth quarter of last year, mainly due to load shedding. Mining production was down 7%, and agriculture contracted 3.3%. GDP growth for the whole economy in 2022 came in at 2%. 2023 will probably be much worse. South Africa may well fall into recession, is probably already in recession. Load shedding cuts about 0.5% off growth, and so that's the problem. The IMF is predicting growth in this country of just 0.1%, sharply down from their previous prediction of 1.2% for 2023. Fitch, the other rating agency, has also cut their growth forecast to 0.2%, down also from 1.2%. So we're expecting load shedding to ultimately cut about 0.5% per quarter or 2% a year off growth. Tax collections in the 2022-23 year were 314 billion rand up on 2021, mainly because of higher commodity prices. But we have a million more registered taxpayers, which is good news. South Africa now has 24.8 million registered taxpayers, contributing about 35.5% of all the tax collected. The fiscus and the tax authorities have been well managed despite the low economic growth rates. Costs have been contained, and the Treasury has done a very good job of holding costs down in government service. South Africa has been grey listed by the Financial Action Task Force, the FATF. So they've been added to a list of countries with dubious cross-border dealings and a lack of rules and controls over money laundering. It will take us between 1 and 3 years to get off that list. It will, of course, impact on foreign direct investment and hence probably increase the cost of borrowing in this country. It may also have a negative impact on the ratings handed down by the major rating agencies Fitch, S&P, and Moody's. And of course, it will not help Ramaphosa to achieve his goal of building up foreign direct investment. But he so far has suggested that it's not significant. We think it is. Private credit extension in the economy was up 8.4% in January. It shows that consumers and businesses are taking on more debt to survive. Additional funds may also be required for implementing solar power. The trade deficit here in South Africa was 23 billion in January, mainly due to the drop in commodity prices. Lower exports of motor vehicles were also noticed, and transport equipment. Transnet is a major logistics problem now, and that had to be added to lower precious metals prices, and the combined effect has been a trade deficit. Manufacturing production fell sharply in February, according to the ABSA PMI, and again this is due to Transnet and load shedding, the combination of those two things. We believe that load shedding will peak, however, in this year, in 2023. By 2024, we believe that most companies and consumers will have alternative arrangements in place. Mining output was down 1.9% in January, much less than expected, and I think that that's because mining companies have already implemented significant alternative energy solutions for themselves. South Africa's terms of trade showed a deficit of 32 billion rand last year, and that compares with a surplus of 228 billion in 2021. Again, that is mostly because of commodity prices. Okay, let's take a look at the rand. Just switch to that chart here, and then I want to pull a bit more data in. Right, this is the rand chart, rand against the US dollar. I just want to go back to that low point there in June of 2021. There you see it. That was the lower point. That's the strongest point that the rand reached against the US dollar. This is where that bear trend began in America. So obviously from that point onwards, we had a shift towards risk on as Americans moved out of emerging markets and into US Treasury bills. So we've got an overall weakening trend, but we seem to have found a support level here at about 1860 to the US dollar, and there's been a bit of short-term strength over the last couple of weeks. And you know that our opinion is that this weakening trend is probably due to a shift towards risk on, when investors overseas move their money out of emerging markets and into US Treasury bills. But there is some short-term strength. We do not believe it will last very long, and then I think the underlying weakness will continue. So just be aware of that. Okay, then I'd like to just talk a little bit about gold, because you know, when things get tough, when investors get concerned about the world economy, political developments, they move into gold. Some of them will move into gold. Okay, I'm just bringing in a bit more data here. I want to go back to 2016, when the commodity price cycle began to rise. You can see there, that was the low point in commodity prices. And from January 2017, you had rising commodity prices and a rising gold price. And here you can see it's made two tops here at about $2,050 for an ounce, 1 ounce of gold. There's the COVID-19 spike downwards, which was just really a spike. And here's the Ukraine crisis. As you can see, it caused this spike up. And now we've had a triple bottom here in October, and right through to the latest bottom has been here in November of 2022. And then since then, the gold price has been rising sharply back up towards this resistance at 2050. So gold is a hedge against the weakness of paper currency. Investors move into gold when they see paper currencies weakening or becoming inflated or debased. They also move into gold if they see a lot of political risk. So something like an escalation of the war in Ukraine such that it involved NATO more aggressively, might cause investors to move into gold. And you can see that there does appear to be a trend towards a rising gold price in the last couple of months. And I think if it breaks above this level of 2050, you'll see quite a sharp upward move after that. Now, what's interesting is to look at the Krugerrand. A lot of South Africans have got Krugerrands, and it's a very interesting chart to look at. I'm just going to put all the data on the screen. So this is all our data on the Krugerrand going back to 1985 and right up to last week. Well, even last night, in fact. And you can see here various things here. This is the 1987 crash in October 87 over here. You can see initially it caused the gold price to fall. This is the .com crash, which also caused the gold price to fall initially. That's the 9/11 Twin Towers attack. Here's the subprime crisis in 2008. There's COVID-19. Of course, this period over here is the Zuma years, the years of Zuma's authority. 9 years there were. That's COVID-19 there. And now we've got the Ukraine crisis over here. And what you can see from this chart, and remember that this chart is an exponential chart. So it's designed to show the relative moves in the gold price at the same percentage level. It's a logarithmic chart, a semi-logarithmic chart. And it's gone up enormously. So here in January or February of 1985, you could have bought a 1 ounce Krugerrand for 595 Rand. Today, the same Krugerrand is costing you about 38,700 Rand for that same Krugerrand. And you can see, therefore, that gold or gold coins have retained their value, more than retained their value. But of course, the problem with gold is that it doesn't pay any interest, dividends, or rent, and it doesn't add 10% to its weight every year. There's no return. So all it is a hedge against the weakness of paper currencies. We believe that South Africans, because of the relative political risk in this country, should keep about 10% of their wealth in gold. That's what we believe. Gold coins, gold ETFs. All right, let's look at a few companies now. We had a new listing. Premier was spun out of Brait and Premier Foods, and Brait will be keeping 47% of that company. There wasn't any initial public offer. The listing was done through a private placing to major institutions. Of course, Premier is a food producer which competes with Angloval Industries, Tiger Brands, RCL, and other companies like that. It came to the market before it opened on the market. The shares were sold for 58 Rand and 20 cents, and as you can see here from the chart, they've been hovering around 60 Rand a share since then. This is a major blue chip share, and we believe it will do well. In 2022, the company had revenue of 14.5 billion Rand and an EBITDA, that's earnings before interest, taxation, depreciation, and amortization, of 1.5 billion. So it's quite a considerable company and will be a blue chip food producer. All right, then we had good results coming out from Bidvest. Bidvest is obviously a very highly diversified company. It's got dozens of subsidiaries which are gathered into 6 main divisions, but it's one of those companies, one of the very few companies that believes in diversification rather than focusing on a core industry. Diversification, of course, reduces risk. So because when one division is down, the others are up. In the 6 months to the 31st of December 2022, revenue was up 14%, and headline earnings per share were up 15.3%. Now, Bidvest is talking about investing in alternative energy sources. Obviously, that's going to be a big profit generator here in South Africa particularly. The share is in a steady upward trend. Just put a bit more data on the screen. Okay, there you can see the upward trend, and on a price earnings ratio of 16.3, we believe that this is good value. Okay, let's look at another new listing, CA Sales. This company listed last year on the 27th of June. Put 1 year on here. No, let's go back to 6 months. Drag in a bit more that way. Okay, you can see it listed in June last year, and it's been doing very well. Now, it supplies food, health products, alcohol, and fast-moving consumer goods. In its results to the 31st of December 2022, revenue was up 18.2%. Headline earnings per share jumped 31.2%. It's one of the very few new listings on the JSE over the past year, but we think it's a good investment. It's trending up nicely. Okay, and then Master Drilling. We've spoken about Master Drilling before. This company specializes in drilling holes in the ground, mainly for mining exploration, and also for they're using this technique for other things as well, like drilling for transportation, underground railways, things like that. But mainly they're focused in the mining industry, and they've developed a new horizontal drilling technique which allows them to drill either a rising or falling inclined hole. The rise or fall can be 12 degrees either way. And what they do is cheaper and quicker. It's like a tunnel boring machine. It's cheaper and quicker than the old blast and clear methods that used to take place in the mining industry. In their results for the year to the 31st of December, revenue was up 31% and headline earnings per share up 21.9%. They were in a downward trend, but that downward trend was broken in March 2021 at 806 cents. The share is now trading for 14.20, so it's done well. And in the last month, since I last spoke to you, Transaction Capital, we have to talk about Transaction Capital. They had a meltdown. They had to suddenly make a 1.8 billion rand provision for bad debts. You can see the meltdown over here. The share price fell like a stone. And this was really not predictable. Nobody predicted it. Very unpredictable for private investors. But if you'd had a stop-loss strategy, you would have got out over here, somewhere over here, in this gap here. That's a 20% stop there. So at that point, the share was trading at about, you would have got out around about 40 Rand. If you'd had a 10 or a 12% stop loss, you would have been out earlier. So you see, this is very important because it shows you the stop loss strategy helps you at all sorts of times when what is going on is not predictable. You don't know why the share is falling, but it is, and you recognize that. You recognize the fact that there are probably insiders who know a hell of a lot more about what's going on in the company than you will ever know. And they're going to trade their shares. And when they trade their shares, they're going to move the market. So you just have to have a stop-loss strategy that prevents you from losing too much money. Note that the share fell to about 860 cents or thereabouts over here in March. And it may now represent an oversold position. But we recommend that you apply a 65-day exponentially smooth moving average. There you can see it on the screen. And wait for the share to break up because there might still be some further bad news. So you wait for the 65-day E for the share price to break up through that moving average. And usually when it does that, you're on an upward trend again. Okay, finally I want to talk a little bit about Gemfields. This is an interesting company. They have two mining operations, one in Mozambique and one in Zambia. And the company has, as its CEO, Brian Gilbertson, who is pretty well known in these parts. It has the two mines. It has KGEM in Zambia, which mines emeralds, and Montepuez in Mozambique, which mines rubies. The risks, of course, of mining in third world countries are quite substantial. They've had a big problem with terrorist attacks in Mozambique recently. But they are a very big player in the world's semi-precious stones. And the share obviously has the usual risks which attach to a commodity share. but it's been doing very well, especially since COVID. The chart is going up strongly, and it'll probably continue to do that. Okay, folks, that's about all I have for you today. I hope that you found something in there of use and of value. Remember that we will be doing another webinar like this one on the first Wednesday of next month. Thank you for listening to me. Thank you.